Hello, I'm Piyush Dave, a fintech professional, and today I'm going to show one strategy based on Turtle Trader. Now, this strategy is about Turtle Breakout Strategy. Now, what does it mean by the Turtle Trader? So, it was found by two people in 1980s, and it is a very famous trading experiment. So, they choose a people which are very ordinary people. They don't know how to trade in the market. So they don't have any expertise, but this ordinary people become profitable trader by just following certain rules. So these two people have made a rule for trading, and they ask these people to follow the rule like what we do in the actual algo trading. In actual algo trading, we don't have any emotions. We know we have no prediction. We only follow certain rule. So in 1980s, there was very little number of computers. So that's why the trading was done manually. So like on that time, there was no computation also. So they just found a simple strategy, and they says this 20 ordinary people, or we can say 50 ordinary people, to trade with the rule for 2 weeks. And you'd wonder to know this ordinary people become profitable trader by just following a mechanical rule which has been set by the company. So turtle means just follow the rule. In turtle trading, they basically use two kind of a range. One is above the value, below the value. They don't do any guesswork. That means no gambling. Rules only. If the signal comes, they trade. If the price breaks above the value, long-term range, then they are going to trade. If the price is below the value, they are going to trade. This is for the long and this is for the short. So they just try to find out what is long-term range and what is short-term range. And if that range breakouts, then only they are going to trade. So let's consider the breakout uses two kind of a cycle. One is 20 days and 55 days. 20-day cycle to 55-day cycle, we can consider, okay, there is a bullish momentum going on. So let me show you this in example. Like suppose we have this 4 layers, this 4 layer, this is 20-day, and this is suppose 55 days. Similarly, on the downside also, we have this 20 days line and this is 55 days line. And suppose we consider the market is moving in between these two. So there's no trade will be going to happen. Suppose if market comes and break this value, then they may trade because there is a chance that market may touch this 55 line also. And if it also get break, then there's a huge breakout possible. The market may reach to more height. So the logic is very simple. The logic is very simple. If this breakout happen, take a trade. And if this breakout happen, take a big trade. Okay, now let me show you on a downside also. Suppose the market is trading like this, and if this breakdown has happened, then take a short trade. And if this also breaks, take a more short trade. So this is a downside part, long-term breakdown. This is the upside part, long-term breakout. Now, they just set a simple rule. If the price go above this, buy. If the price go below this, sell. That's a simple common logic. And it has been followed by all the people. No emotions, no prediction, like what our algo does. So that basically called as one kind of a trader in the market, and that basically called as a turtle trader. Now, why they are successful? Because they follow the rule like algo. So basically, we can say they are algo only with human brain, but they follow rules. They have been trained to follow the rule for 2 weeks. Rule, they don't break the rule, they don't do any guesswork, and you'd wonder to know ordinary people can be a profitable. Similarly, always algo is profitable because it does not have a fear, it does not have a greed. I'm going to show a simulation in this, but we need to wait a lot for this breakout to happen. So if there's no breakout, the market is not going to trade. But I created a simulation just to show that, okay, turtle trader are keep on waiting, keep on waiting, keep on waiting until they basically reach to the rules which has been set by the company. Okay. Now you wanted to know there are a lot of hedge fund in the world globally. They use this kind of a strategy. They made some strategy and uh, they found, okay, by backtesting the strategy is workable, this strategy is profitable. So they hire a people who just execute that strategy. They don't use any kind of emotion prediction. They just follow the rule and based on that rule, they trade. So the best example, and it was carried out in 1980s. You can understand from here that the time was before the technology. So there was no technology, but still this was successful because there was a very simple rule. Normal people trading with the rules and they become a profitable. Like I'll go with a rule is always profitable. So now let me show you the actual simulation environment where we are going to trade with this kind of strategy. So this is my exchange which keep on changing the price, keep on changing the price randomly. We have no control over it. Okay, the price has been starting changing and now I'm going to start my algo. That's a turtle algo. It is going to collect the 55 prices, 20 prices, and based on that, it is going to use a capital. Stop loss is 0.5%. The interval which we are going to use is 60. The loop, this is loop is basically a kind of a slip which we have created. So I think this loop size we need to decrease to 3, otherwise it will going to take a lot of time. Let me run this first and let's see what is happening, how the price has been updated. Okay, this is I think very slow. So it is going to take a lot of time. Let's reduce this loop cycle to 2. So we get a fast update from the market. This is artificially created so that uh, you can have the loop very small. But if I increase this loop, let me show you that what happened if I reduce this loop error, or what we can say loop delay. Let me show you that. Suppose if I keep it only 0.5, the price will be updated very fast. Okay, price updates always come very fast, but the thing is, if we do that process, we could not able to see what is happening in the market. So that's why in the simulation we keep this kind of a delay intentionally. So logically, that 2-second delay is a perfect delay for a loop. We are going to risk our capital to only 1%, and then based on the rules we are going to trade. Okay, now let me start the algo. Okay, let me close down, let me fix this windows so that we can able to see both the things at the same time. So this is my price window which has been continuously updating. I have no control over it. This is my price window which has been treated like an exchange. The price is continuously changing Now change in the price is so random that we have no control over it. We need to wait at least for this 55 readings to come. Then only the long term and short term range will be set. Once this range has been set, we are going to trade based on the breakout. Now, for our case, if the market is in certain range, then it will be very difficult for us to actually get any kind of a breakout or a breakdown. So we might don't get any trade over here because the price is fluctuating in very small range. But let's see what is happening, how the breakout is been calculated and breakdown has been calculated. So we are going to collect the 55 readings from the market. Currently, my price generation rate is 1.2 second as a delay, but this could be very fast in the market itself. So that's why we keep this price delay lower also for a further case. We can keep this price delay very small. We can keep this price delay very fast as per your requirement. So that means fast delay means we can keep it file. Okay, we got the range. Okay, you can see it's happening so fast. Okay, we got the range for 20 days. We got the range for 55 days. And I kept it so fast, so it's happening so fast. You can see it says no trade because the breakout has not reached. Not the breakout from 20, not the breakout from 55. You can see the breakout range for 20 and 20 and 55 is same because the market was trading in the small range. Okay, no long trade, no short trade. It's waiting for either price to break down above 1037. Okay, prices break down, but the range is also going down. So that's why there is no trade happening. So that means it's like waiting period is very high. You keep on waiting till you get a perfect trading base rule. That's the importance of a turtle trader. So the price is changing and the range is not breaking down. So that's why it's not trading at all. That's the best part of the rule which has been set. We need to wait until the price has break down. It's not breaking down the value because the 20 range is also shifting. It's very fast range shift. So that's why you need to keep the delay of the cycle more, then only it is possible to get the breakdown. Otherwise, the breakdown could not be possible. So what I'm trying to show over here, the trade is not going to happen for sure. What I'm trying to show here, the turtle trader keep on waiting until the rule come into their requirement. If there is no rule is coming, they keep on waiting. So for here, our case, they keep on waiting for value to break down. And the value is not breaking down, so that's why they still keep on waiting. Okay, you can see the 20 range has been shifted. 55 range is still the bigger range. So you need a volatile market to either break down or break. I hope the concept of the turtle trader is clear. What I'm trying to show over here, if you have no emotions, only rule-based trading, you can be a profitable trader. Ordinary people can be a profitable trader. So if you know certain part of the trading, then there's a rule-based trading. And if you follow the rule, then maximum chance of getting the good returns. I hope this concept of turtle trading is clear to you. Thank you very much.